We're looking at the Comp Q, which is the Nasdaq Composite. This is Mark Espy once again, and must remind everybody that everything we speak about here is for educational purposes only, not meant as a recommendation to buy or sell anything. We broke down out of the channel just as had occurred in the other indexes, clearly breaking down below the low of the channel on decent volume. The follow-up day was a spinning top, and then we had the fiasco day where it broke down and traded wildly due to computer glitches and fat fingers. Then we traded down once again on Friday, and then gapped up on a recovery on Monday of this week and continued up with some follow-through days, and then we had this bearish harami and then a gap down, trade down. And the volume though had decreased, but today's volume, Friday the 14th's volume, was actually a bit more than the prior couple days, so there seemed to be some credibility with the move. And as I had mentioned to you before, the VIX has increased dramatically. It was up about 4 points plus today, which indicates that there's continuing fear in the marketplace and people seeking after puts. My sense is that this will continue to trade down and test 22.25, which was the spike low of the Friday following the fiasco day. I really don't pay a lot of attention to this wick that came down on May 6th because I think it was not credible. But I am paying attention to the wick as indicated right here by the arrow that was put in on last Friday. There's a lot of market symmetry on this level as well. As you can indicate here, there was a consolidation period in late February, one again in late January, and then we had several touches on it in the last part of the year last year. So I think there's some credibility with this level. We are in a channel. It'll be interesting to note whether this channel begins to narrow or whether we continue to trade, and this is a fairly wide range channel as is in the other indexes. The stochastics is beginning to turn over, it looks like, just very slightly, and the MACD remains below the zero line. And although a little lessening, it indicated a little lessening in the momentum, but the histogram is indicating at least it's flattened a bit, and it may in fact come back down. If it continues to move back down toward and test this, this will widen from the zero line to the south and indicate quite good momentum to the downside. I guess I must suggest to you that you remain hedged. There's so many stories I heard this past week about stops being blown through and not regarded, and wild pricing. And I was in front of the computer, obviously. I'm a full-time trader. I was in front of it when it was occurring, and bid-ask spreads were so wide you could drive a truck through them, and the numbers were just didn't make any sense at all. So I would suggest that you may want to consider hedging. If you have a put on, that's a contract, and you don't have to worry quite so much as it blowing through a put because you have a contract to sell at a particular strike price, and that's contractual arrangement. So to me, that's a much more comforting feeling rather than having a stop. But be that as it may, everybody has their own trading style. I think that that's something maybe though to consider. So be nimble, be careful. The market is pretty wild out there. It's not for the faint of heart. So I look forward to seeing you next week, and have a good day of trading.